I am delighted to moderate this session on blended finance, and I am joined by a real expert panel. I'm joined by Leah Pedersen, who is the Director of Market Acceleration and Design Innovation. I nearly forgot the design. At Convergence, which some of you may know is a global network supporting blended finance. Jiao, who is the COO of Catalytic Foundation, previously R20, and they are driving design of blended finance using experience of value chain approach. She'll explain more, I'm sure. And I'm joined by Dr. James Smith, who is the Director for Nature-Based Solutions at Poseidon Capital. They are a green advisory and investment firm who are driving investment in nature-based solutions at scale. And last but definitely not least, Pierre Rousseau, who is an independent senior consultant, but previously was the senior advisor on sustainable business for BNP Paribas. And all of them have different perspectives on blended finance. And I'd like to start the discussion by asking what, well, actually, no, I'm going to set the scene first, I forgot that bit, which is, blended finance, as some of you may know, is not a new concept. It's 10 years old, in fact. Its aim is to blend public and private, sometimes with grant financing, to drive impact, which is fundamentally about giving finance purpose. Is it delivering? That is the critical question. And that's the issue that we're going to discuss, and I hope you'll start thinking about the questions you want to ask as we progress. So Leah, I'm handing over to you. Do you think that blended finance can deliver the impact we need?
Sure, thanks. Actually, I think I'll turn that off. I'm assuming everyone can hear me. I'll keep this on then. No assumptions made. So with that, do I think blended finance work in a way that we're trying to achieve our broader development goals? Yes. I think that blended finance has a purpose with respect to certain SDGs, recognizing it's not applicable to all SDGs. And so when we're looking at climate adaptation, climate mitigation in particular, I like to focus on SDG 14 and 15 because they're severely undercapitalized. So blended finance is meant to be a tool, a structuring tool that really uses tools that drive more capital towards undercapitalized SDGs or development objectives. So I think it is a tool within a broader toolkit. It can't be alone, and it's certainly used alone and can't certainly be used alone without any projects. Hence, we have a good panel to discuss projects in particular. But I'll stop there, recognizing that it is a tool, and we'll tease out some specific examples.
James, in response to that, would you like to build on that?
Sure, very much happy to do so. So I think I'll start by saying that we had a lot of discussions yesterday about where the voluntary carbon market is going to go. And fundamentally, from my perspective, the reason that we have a voluntary carbon market now, and we're in the position where we're looking towards growth and trying to understand how that can help corporates meet their nature and climate commitments and reach towards net zero goals, etc., is because blended finance funds and structures in the past have been successful. They've brought together the public funding to de-risk what was considered to be a very, very novel asset class, and through funds that are focused on, for instance, microfinance, and also those focusing on the first investments in REDD+ projects, and also ARR, so forest restoration and afforestation projects. We actually have got to the point where we have successful projects in this market that have a 10-year track record and have demonstrated that they can generate returns, they can generate impacts on nature, and they can generate returns for communities. So the first thing to say is that actually, in my view, blended finance has already demonstrated success in channeling finance towards these activities and impact. Is it enough? I don't think it is enough. No, the comment was made yesterday. We have 6.5 years to reach our goals for 2030 on the Paris Agreement, etc., and we desperately need to scale up finance to meet that. SDGs 14 and 15 have already been mentioned, desperately underfunded. And the issue we have here is that although we see a number of large-scale private investment firms and banks, etc., making commitments to launch a new fund. You hear almost every week a new fund being launched of however many million. They're looking for fairly large investments that are probably also not yet available in the market. And so there's a really important role, in my view, for a continued investment in blended finance to reach the impact we want, for blended finance vehicles to be focusing much more at smaller scale, newer organizations and companies and projects which are starting up, which are looking to grow and looking to scale. And we need blended finance to catalyze and facilitate these projects coming to market so that others can then help scale and move them forward.
Thanks, James. I think we've got a sort of sense now that blended finance is a toolbox, that there's a need for it, and there's a need for it to do more. Jiao, from your perspective, forming Catalytic, what is the role of Catalytic, and why do we need Catalytic to make blended finance work better?
Well, I think definitely Catalytic is one of the players of many, and that's what exists now is still very small compared to what's needed. We decided to change our name from R20 to Catalytic Finance Foundation, short for Catalytic, mainly because based on the track record of the Subnational Climate Fund that we curated with partners like Gold Standard, Pegasus Capital, IUCN, to bring this flagship blended finance vehicle together, we see the need of, on one hand, bringing the private sector, investment sector, towards projects. So I think on this point, blended finance is a good tool, and there's a lot to be said about it, how you blend, and there's still a lot of innovation needed, and it's happening really. On the other side of the scale, if we see it, there's also a tremendous need for project preparation. We hear there are a lot of sayings, there's not enough projects, or there are enough projects. The truth is there are a lot of projects, there are a lot of intentions from the public sector and private sector, and we work with them in preparing particularly infrastructure projects aiming at mitigation with adaptation benefits. But every investor or fund has its own specific strategy and goal, and the project preparation has to be there to really bring this project to the needs of the investors and also impacts. So we're looking at impact goals and business goals from whoever is behind a blended finance fund or a project, because blended finance is at many levels, right? A project can be financed by itself by different financial sources, and the art lies in risk sharing. And I think that's a topic I would really like to, focus on I think now and in the future in the blended finance sector, where how we can be more innovative in bringing different partners, because all of us have our own expertise in impacts, in structuring, with common vision, because our vision is all the SDGs and climate actions. If we can sit together and be clear about what's each other's bottom line and structure a fund or a project in an innovative way, and a lot is happening in that already. We are working with partners that are continuously creating blended finance, not only investment funds, but portfolios with really great ambitions that consists of different funds, and different partners takes different risks. So I'm very hopeful and positive about what blended finance can do, but also what partners like Catalytic, we also what is important is also to help project towards the goal of the investors, of the concessional capital providers, to make them meet in the middle.
So to the question we've got, can blended finance drive impact? We've got, it's a toolbox that can do that. We've got, we need more of it, and we've got support mechanisms to help it happening. So it's all going great. Is it? 10 years later, are we delivering on impact, Pierre? Are we delivering with blended finance?
For me, blended finance is a little bit like the voluntary carbon market. It's an unachieved process. And keep in mind a few things if we talk about the system. I think academically speaking, and with the support of a certain non-profit or boutiques, I think today this has been pushed. OECD has made a lot of writing about it. Convergence is working on it, Systemic. You guys, you're making some project. But the problem is that it has not been taken at the higher level of the finance. Finance is regulated, number one. There is no regulation on blended finance. So there is no enforcement, no pressure. That's number one. The second thing that we need to think is that blended finance is a different way to do finance. So it means that if you want to be successful, you have to put all the players at the same time around the same project or the same fund or the same ideas. Here it comes one by one. So each time you come and you have a problem, and all my experience that I have, and I've made some success and I had some failure, and the success was only when you had all the players at the beginning talking about the same subject and not having one coming one after one. Especially majority of the blended finance today, you have the public first who set the scene, and then you have the private, and then we call for the private. But there is one thing, even if everybody speaks English, majority, that's the English language we have, nobody understands each other because we speak different language. And so we don't have a common language. And we forget about finance. There are several drivers. The drivers number one is regulation, no regulation. The drivers number two is emotion and behavior. We believe that finance is driven by common sense, and it's not. It's driven by emotion. And today, in blended finance, people have the wrong emotion. Because when you come to front of a private investor and you tell him about risk, he will be defensive. The first reaction he will have, what is wrong behind it? Because people focus on risk. If you're an investor, you want to hear about the return. And the second mistake we do is that we talk about return, but here is not about return, it's about impact. I've never seen, or very rare, when somebody presents a project starting by impact. People start always by risk, which is the wrong way, not by the opportunity, not by the changing. Finance, we used to think about the past. Everything is about what has been good, we want to replicate. Here, we have to reinvent the future. So we have to have a different behavior. And another behavior is about the fact that you want to do something, you want to go. And we need also to be in a market which is push. If you want to be comfortable, emerging market, which is the place where we have to go, normally it's only 7% of the total investment of the private investor. And then you come with a project and you will tell them that you will de-risk because there is some risk. How do you think he will go? He will be negative, he will be defensive. Same thing about the project people. The project people, when they got in front of, and there is a lot, I want to say, there is a lot of good projects. I'm supporting some very good projects. They are there. But when we go in front of the private investor, we market it wrongly. And we market it, we don't say about the impact, we don't say about, we try to justify the risk return. And then after that, the guy say, yeah, but on risk return, I have other opportunities somewhere else. So I go somewhere else. And we don't go for the specific. The only way we can be specific is to start by the impact. And then there is another thing that maybe later we can talk about it when the solution, because there are some ideas of solution. Finance is not an innovative business. So we are lacking of innovation. So if we have to reinvent the future, we are trying to do the future with the old system. And this is what is wrong. We need to reinvent, we need to do innovation. And today, finance is not doing innovation. And why it's not doing innovation? Because we regulate it. And we're quite satisfied. And we have enough business because we are protected by our regulation also. So this is what we have to rethink about.
Okay, this is a very interesting perspective, and I'd like to ask the other panelists to maybe react to what you've each said. I think it's interesting to think about blended finance as a toolbox. It's interesting to think about how to make projects access blended finance. And so could you just, thinking about what the other said, think about your reactions? And I'm just going to open it. Who would like to react first to what you've heard your other panelists say?
Sure, I'll jump in and react a bit to what was just said with respect to regulation, innovation, and And Jiao mentioned sort of the catalytic nature of finance too, or some of the work that she's pursuing. So blended finance, by its very nature, is not meant to be regulated in that it's attracting capital sources that should be regulated in and of themselves. So for example, if an equity player is coming into a market that's not highly regulated, that in and of itself is a risk. So, or a debt player, et cetera. So it's really not up to the obligation of blended finance to be highly regulated. It's our obligation within the context of blended finance to attract public sector capital and or public sector players that can enforce the possibility of recapitalization at the time of, for example, a sale of a company, so that opportunity is more attractive to an equity investor. So I say that because sometimes there is a conversation around regulating blended finance, but I think we sort of then get stuck in a zone where we might not be able to use it in terms of its catalytic nature. Now, turning to its catalytic nature, I wanted to tease out, you brought up, I think, a very good point with respect to project preparation. We see this quite a bit in our pipeline overall. So that's a huge need right now with respect to grant capital and catalytic capital. And there's also preparation when it comes to designing vehicles, blended finance solutions, blended finance funds. So you think about it, the average private equity fund or debt fund already has an idea of how much it's going to cost to start a new fund. We'll multiply that by at least 1.5 times, if not more, with respect to designing a new nature-based solution fund. And that's where design funding within Convergence can step in and be highly catalytic at that early stage. So I want us to be able to break down the conversation according to value chain and value proposition across that value chain.
Perhaps I could jump in and go next. I'm enjoying this discussion immensely already, and sitting next to Pierre, you always throw out some firecrackers in front of us and get us thinking. A lot of points to build on. Pierre, in response to some of what you said, I agree with much of it, but also I also think that some of the blended finance vehicles and investments we've seen in the past have done exactly what you've said. They come from the perspective of impact. They want to develop, whether it's nature-based solutions or social impact or something like that. And it starts with philanthropic donor money working with a project saying, okay, how can we scale this? They'll bring on board, financial partners, et cetera, and they'll say, okay, finance not being an innovative industry as you've highlighted, they're then starting to retrofit existing models and existing mechanisms which investors are familiar with, and then them taking them out to institutional investors to try and raise the finance. And so you end up with these really awkward situations where you lead with impact, you then retrofit some form of financial mechanism, you then take it to the investor, but then coming back to kind of the donor financing and the project developer, they probably don't know the financial industry and the needs of each of the financial stakeholders well enough. And you end up with kind of great impact opportunities and blended finance vehicles, which are then going up to, a large institutional pension fund or insurance fund saying, we've got this great niche mezzanine debt thing, which is de-risked with a, with a convertible blah, blah, blah in year 4. And I say, well, we can't do that. And like you said, there's also something else in the room which we understand and which is fairly plain vanilla and we can move forward with. So I think that's one point. And then, of course, because it's immediately because it's considered risky, or has been in the past, everything around nature-based solutions and social impact, et cetera, is still fairly new for the market. I mean, the market is only still kind of getting up to grips with ESG, right? So in that perspective, you then get multiple different DFIs, so development finance institutions, coming together to kind of de-risk it together, each of them bringing their own slightly different focus on what's their priority, what's their impact interest, and then you end up potentially with bloated investment committees, they've got, each want a seat on the board, et cetera, and then what does that fund even want, and how are they going to drive impact when you've got so many cooks in the room? So I've spoken for far too long, but I'm loving this conversation.
James has said it all, so I have to think what to say. No, there's one point that I wanted to add, particularly also from our Catalytic Foundation perspective, as we position ourselves kind of in the middle between projects and investors, and we try to make them meet. I think the point is through working in this sector in the last 5-6 years, we come to the point to really realize there are a lot of needs we have. The 1.5 degrees target may be too late, but we are still working towards those goals and adaptation. But we work with both sides who want 100% of what they want. Impacts 100%, investors 100%. For us, our success lies in if we can bring the two ends together and each achieve 1%, 2%, that's being very realistic, or 10. That's success. We're making things happen. We don't have the time to really wait for a perfect project where we have achieved all the SDGs and we have achieved all the return requirements of the investors that we're working with. So I think that's also something that we try to work with, being pragmatic. The goal is to make things happen in a short period of time when we're running out of time for mitigation and adaptation as well. That's also a topic that James mentioned on the innovation. I will stop here. The next one for the next question.
Yeah, maybe I will requalify the word regulatory side, but I think there is a lack of guidance. You have to understand that all those people, and I come from that industry, we are used to work with regulation. So if there is something coming from there, we're not doing it. We are not doing it. The only exception is probably China, with dealing a little bit differently. But you will have, nobody will move in the private sector if there is not a rules there, or if there is something. So you have to, it's a mindset. We need to live with the mindset of the people. We need to understand it. So we need probably, maybe not a regulation, but some guidance, or at least some support for it. There are other factors also. We are working in private finance with the short terms. Here we're talking about long term. So it's another mindset. The only people in finance who work with the long term are infra fund. By the way, the one that what are today moving faster in the blended finance and the infra fund, because they do understand the long-term view. They do understand also how to deal with the negative cash flow. So my point is that we need to move now from a concept or some good practice which has been done. There are some good fun, and I've done some, so I'm quite happy. So it works. But we do not manage to replicate them. We do not manage to scale it. So we need to do that. We need to bring more people. And so we need probably to think about first what I call the 4E. The first is educating. We're not educating enough people about blended finance. So we need more education, and we need to push, and maybe we need to force more education somewhere. The second one is engagement. Blended finance remain the things from small specialist people. But the overall finance, even the retail is not even involved in that. Maybe we need to push everybody and to engage more. There is no engagement, and there is no enforcement also. So if you have no enforcement and engagement, it's difficult to make things happening because people are reverse adverse to the change. And then the last thing is about efficiency in general. Efficiency in two ways. The first efficiency is the efficiency in the way we do things. Today, I remember the first transaction we did, we had 40,000 emails to make things happening. This is impossible to replicate, of course. So you can imagine that's a language problem. So even by writing, it didn't work. So this is efficiency, because another example of efficiency, everybody take his own lawyer. So you have 5 people around the table, 5 times 100,000, 500,000, and you cannot imagine the number of paper. The first transaction I did, it was because it was listed, we had 1,568 pages of documentation. Who will read that? So nobody will go for that. So we need efficiency on the way we do things. And to do efficiency, maybe we can talk about solution and to improve that. And then we come back to a regulatory things, because we need to create a structure to make it happen. So this is where I come back to the regulatory aspect of it. And the efficiency also on the way we market. So if you go to an investor and you explain already that the impact you will have, and you can have quick win by circularity, efficiency of the project that you can present, so then you will reinsure. I want to give an example. On agriculture, you can start by cutting the waste and do biochar or do electricity. So instead to regenerating the soil and focusing of how long it will take to regenerate the soil, you can say, I will start to make money by doing biochar or by doing this, and I will generate revenue immediately. Then you have a different perspective to show it, and you use efficiency, and you show that efficiency systematically leads to sustainability. And efficiency, we can do it immediately. So this is just to explain, we need to be more engaged, we need to be more practical on the way we do things, we need to be more marketing, and we need also to be more engaged and technical. We need to solve the efficiency of technicality.
Thank you very much. I think that's been very rich. I hope you're enjoying this. I am. So we have some different views emerging and different perspectives from a place of experience. I hope you're getting that. So as I said, these people have a lot of experience in the financial market and experience with blended finance. With that in mind, given that we have a tool which can bring together projects and finance, which people are really interested in doing more from an investment perspective, but that there are problems with it, how do we improve based on the experience? What needs to evolve? I think you've been hinting at it, Pierre, with your 4 E's. I'm not going to require that everybody sticks to the 4 E's, but it's not a bad starting, springboard into how do we evolve this toolbox, this opportunity? What's working well, in your view, and what could be improved? In addition to what Pierre has shared with us, there's clearly, we're not there yet. It's got the potential, I'm hearing, but maybe it needs to refine itself, its model, its approach, through regulation, efficiency, digitization, maybe? Thoughts, please. So handing over to you, Leah.
Yeah, I'll kick it off. It's an excellent point in terms of efficiency gains. And I'd like to say that over the past couple decades that we've gained some efficiency gains in blended finance, and that it takes only a couple of years to structure blended finance solutions as opposed to maybe an entire decade. So we are making some efficiency gains, but with that, the issue remains that blended finance is highly complex. And oftentimes the players that Pierre's referring to come to the table not understanding their role, not knowing their role, and they each have defined an interest and oftentimes not able to communicate those interests to one another. Certainly finance has its own way of speaking in and of itself, but as long as the conversation is solution-oriented, then I think those players can drive towards the end objectives. With respect to how do we solve some of these bigger challenges, and can blended finance use engagement? Again, I'm leaning on one of the E's there. We are working more increasingly with regulators, not going back to the regulation conversation, but central banks, in that we sort of, there's a judgment call / assumption that's made very quickly. If we inform and educate the finance community, everything else will work out. And that's not exactly how it works, in that the finance community, as it's been mentioned before, is leaning on local ministers of finance, local regulators, local central banks. So oftentimes within blended finance, we have jumped far ahead and beyond some of this, where the stakeholders can actually play a critical role. So I think with respect to engagement, there's the higher level piece of regulators, central bankers, and then there's the lower level, sort of grassroots level piece with respect to the community-driven aspect of blended finance. We're bringing in a lot of financiers to, for example, address nature credits. And Unilever is an example of a large organization that is placing a long bet on nature credits. Therefore, we're seeing a lot of activity in blended finance in terms of NGOs stepping forward and financiers and saying, how can we create a marketplace for these corporations? We're not necessarily bringing forward as quickly the community-led conversation, and that can actually create a significant stumbling block at the end of a complex transaction that requires 40,000 emails. So I'll stop there and saying we can't forget everyone along the value chain merely because we are structuring financial solutions. We're actually structuring solutions.
Thanks very much. Anybody want to go next? I think there's a community aspect which I think you could very well speak to, Jiao, here, but I wouldn't dismiss the other side of the value chain since you work across it all.
Yeah, so we work with a lot of partners, and there are many 4,000 emails for us to track. But I think I would like to also come to a very basic, and it's already mentioned, but with the Subnational Climate Fund, for example, we work with the nationally designated authorities to the Green Climate Fund, because the Green Climate Fund is our anchor investor. What we realize in our capacity building events is that, you know, the basic terminologies, what is debt, what is equity, what's guarantee, how they work to the public sector, and largely also the NGO sector is you know, lacking. When we talk about, you know, equity, it for investors it's an instrument, but for the public sector largely they think about fairness. So we have a large gap in even under, like, talking the same language there, and it's something actually very basic. It's can be addressed. How I think all of us working this sphere can really do something towards that, and also how blended finance can, I would say how it can improve. I think it has delivered a lot, and we have learned a lot from, you know, the funds that's created. We need to really sit down with the partners, the public, the concessional capital providers, and now here in this sphere, we are not only talking about the, you know, governmental funding, which has been historically for blended finance the case, but also philanthropic funding, trust funding. It is kind of a, you know, new thing for them, and there also we're talking with them to, I think to say educate is a bit patronizing, but you know, to bring awareness to what kind of role that philanthropic funding can play in blended finance, and we've seen some, you know, pioneers like several foundations like the Rockefeller, Bloomberg, jumping into this sector, taking different risks of a particular sector in adaptation. For example, Rockefeller, I think they have come into some funds to cover the foreign exchange risks, and that's just an example. I think there's a big potential there for other actors.
Thanks very much. Now, Pierre, moving to you, so you're not always the last one to speak.
I just want to give you, do you know what is the largest blended finance which has been made recently? Is in France. It's called the PGA, the private guaranteed loan for enterprise. You know, on many times it takes to make it happen 4 days, because under COVID, the Ministry of Finance called the 4 banks and say, look, we will lend the money to the enterprise where we define which enterprise ought to do it, and in 4 days they put in place the PGA. So it works, and you know, it was under the pressure of the COVID. So this is why I come back again. If you have this kind of driver at the beginning, then suddenly you can have a government in South Africa, somewhere, we can decide I need to do my transition, so I call the people on the table and I make things happen. This is what I mean. You need this drive. You need this drive you need to set up a platform to start with and put the actors around the table and let's make it happen. So that's one thing I want to say. After we have to work on, and I come back on the behaviors and the way we have to think, because we are not doing the same finance. Finance is the only part which is not changing in the changing world. And we try to do finance by plugging the old world. So we need to reinvent the new world. But we need to change mentality. First, collaboration. Finance is the biggest silo, is the biggest silo structure that exists. I experienced it, I was there. So this means we need to break that. We need to, collaborative is a new way to work. And collaboration is not just to put next to each other, is to integrate. So that means we will have to go for a new governance. We need something, a platform, and we need a governance. So you need to set up a governance that will drive that. If you keep everybody in his own, everybody will take only the responsibility. You talk about the Green Climate Fund. The Green Climate Fund feel only responsible of the Catalytic. They don't feel responsible of the project or the fund. So this is, if somebody is not entirely responsible, it doesn't work. It's not the same game. The second thing is that in finance, we do product and we push product. Solution is not something that is familiar in finance. in private sector. We're not used about, finance has been always to push a product in front of a client. So it's a mindset which is different. Bringing a solution, need to change the mindset, especially when you work with empiric data. So the way we work was always based on the past. So now we have to anticipate the future. It's what we call future scenario. So you can imagine we have to change all the mindset of those people in finance, that you don't have to think on the way you do it, but you have to change your way to think by thinking differently, including impact, because we have to measure impact. Measuring impact is also another way to think that has not been used for the people in the private sector. So we need to bring that. And to bring impact, measuring impact, we need also to do digitalization, data, innovation. So we need data. So it's an additional layer that has not been put traditionally in the finance sector. Okay? And I have two more, if I may, very quickly. There are new risks. We are always regarding the old risk, but there is one risk that we have not teach yet to finance people, is the risk of inaction. And I think we need to learn the risk of inaction in finance, and then things may be changed. And the last one is transparency and trust. Things is still not transparent. And even in blended finance, we talk about mobilizing and committed amount, but we don't talk about investment amount. And always is that it's probably better. I know I will not be bad because I know the invested amount and I will not tell you how much is invested. So, but that's important. We need to stop the committed, we need to stop the mobilized, we need now to see how much has been invested and what kind of project has been successful and try to replicate them.
Okay, James, this is a really hard one for you because you are the investor and you are green. So Pierre's asking you to go on an education story. I think you've done that at Poseidon Capital. I think you have translated or learned how to do investment differently. But how far along the line that Pierre outlined are you prepared to go at Poseidon?
Very good question, and so much to unpack from the previous three speakers. And pleased to go at the end because I see there's 19 minutes 33 on the clock. So let's make a start. Oh wow! Firstly, we've heard about solutions, and we need to develop solutions, and we've got a finite timeline to do so. You highlighted already, Pierre, just how important it is to break down those silos and get everybody collaborating, and I think that's very, very important. And we're here talking about blended finance. Blended finance is basically a public-private partnership, but frankly, we also need private-private partnerships. Just getting an infrastructure investor next to an MBS investor, next to someone who's engaged on plastic waste and recovery. We had a conversation about this last week, and simply sitting in the same room and saying, and then them sharing their challenges. We were able to workshop and say, have you considered this? And I said, that's a major challenge for us. That's a really neat solution. We have to break those silos down. It's not just public-private to actually reach our goals and to make the impact we need. It's private-private, and we haven't solved that issue yet either. But to come back to kind of the blended finance point, I think if I look back at I'm going to deviate from what you've asked me, but if I look back at the title of this session, which is kind of, what do we need to scale to trillions? And the discussions we've had yesterday and all of the research we've seen about the voluntary carbon market, 50 billion by 2050, 30 billion by blah, 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 blah. All of these estimates are fantastic, but I think the question we had yesterday in one of the sessions was what's going forward in the voluntary carbon market and what's happening with regards to blended finance, which I think is necessary to scale that up. Fundamentally, my concern here are what I think are the real drivers of change in everything we're doing in sustainability is fundamentally regulations. To go back to a point that Pierre's made, it's regulations, but are those voluntary, or are they actually implemented by government? And I would say the most change we've seen in the last 2 to 3 years, which is driving the carbon market forward, which is driving companies to change their sustainability sourcing patterns and also driving investors to come up with new investment vehicles, is, for instance, SBTI and all of the commitments that corporates are making to go net zero. And I would like to say, and I think that if we want to scale to trillions, we have to move away from this idea, okay, blended finance, we're just going to be focusing on some niche new products or startup companies or this landscape here, whatever. We'll bring in a DFI and we'll bring in a private investor and we'll launch our fund, whatever. But we have to start thinking about landscape scale, jurisdictional scale investments. And that has to link back to SBTI commitments, the kind of sourcing from smallholders, from big, fast-moving consumer goods companies, etc. We need to be getting them engaged in public-private partnerships and developing blended finance structures for them, because we need to be effectively helping to translate and to transform their entire business model from the land upwards.
Thanks, James. I think that's a really important point that you just made, which is traditionally when we think about blended finance, we think it's like in the Subnational Climate Fund, it's public money from the GCF that de-risks an investment area, that brings in private capital. To your point, Pierre, they come late to the table. Governance is a bit different because GCF feels responsible for a money flow for a part, the concessional finance, but not the whole project. That has to be negotiated, and then you have to find the pipeline. But there is another way of doing it, and I think it's really important to remember that, particularly with many of you in the room who are looking at projects, is that if we can define an envelope, call it landscape, ecosystem, jurisdictional, integrated agriculture area, a river basin, for example, you can then identify what can a corporate invest in. Can they go beyond their supply chain? How much more can they do? And what's left? It's public. Do they need to sit at the same table? Pierre's saying they do. Anyway, I'm leaving it at that, a little bit of a question. I'd love to hear what you are thinking in the room, and I would like to open up, if we could light up the room a little bit so that the panelists can see who's in the room. Have we got any questions? Oh, great, we've got a question right there already. We've got a question there. So if we could take the questions, and I'll take 3 questions. And then I would not ask every panelist to answer every one, but it would be good if you let me know by when I say who would like to answer this, you put your finger up, please. So, if we could just give the gentleman here.
Thank you very much for a very interesting discussion. Bamshah Tushani from South Pole. The problem I have today with the current financial models or solutions is that, for instance, if it's applied for a wealth maker or for industry, we take into account, obviously, direct revenues, and for that industry itself, they take into account future cost savings, right, to make their models work. What I see today, we are talking about impact finance and other solutions, but we are still using the very traditional finance models we have for ages. And for me, is if we take into account, if we talk about climate crisis and the fact that what we are trying to do today is going to save our planet and save lives and islands, this is a huge amount of cost saving that today I don't see any of current financial solutions or models we're talking about are taking into account. And if they do, probably impact finance will be the most attractive business models to invest into. So what is the discussion around that? Sorry, I just wanted to have your opinion. Thanks.
Okay, can we take the second question? No, we take the second question. We take 3 questions and then you can think about it.
I'm still Frank, and I still come from Norway, the biggest polluter and the most rich country in the world. And I can give you the address to a bank in Norway. They have 15,000 billion Norwegian krone. And last year we made 1,750 billion extra on the war in Ukraine selling gas. And so just ask me, I can tell you where you can go and get this official money for the polluters have to pay. So that was not a question, it's an advice, so good luck.
Could we please take questions from the floor? Thank you.
Hello, Thomas Harry from Phoenix Carbon. I had a question about, so blended finance, we look at it and I think of it as a way to get where we need to go, but not necessarily, the way we want it to work forever, just giving a nudge to make this market work. So my question is, can we take a step back and think of what does this market look like? What is it that we're trying to achieve? How does it work when we get there?
Ooh. Okay, so and I don't want to be dismissive of the Norway comment because I think it's a very valid point, which is if people are making so much money through polluting and through war even, how do we get blended finance, which is a nascent thing, to work. Anyway, I didn't want to be dismissive about asking questions. I think it's a valid comment. So coming back to the two questions, so who would like to answer the first one from South Pole? Thank you very much. On traditional models, we're still using traditional models. I can't see the innovative solutions that we need. What's going on? Sorry, bad summary.
I can start if you want. Yeah, I fully agree. That's the problem. So we're using, this is what I tried to say. Maybe I didn't say it properly. So changing is to bring new ideas, and then it takes time, and you need to involve the people. You need to involve the banks, the people. So what we do present today is to start model, and we start with the people who have a vision of the long investment. So with insurance company, for instance, are the one we can try. And so what we do, we come with an impact. So we said we will consider the impact as the goal, and we have to achieve the impact. And then after that, we will guarantee a minimum return on the long period. And so that means you don't try to achieve the best return. You guarantee a minimum, and then you will use the catalytic to cover when you don't achieve it. So you will cover the performance. So that's the type of things that the problem today. When the idea is good, and I think the people are interested, but what we have to fight now, it's regulatory issues, because we are going against some principles which are in the regulatory, and so we need to tackle that. And so we're working with the insurance, for instance, to tackle that problem, because it will impact the capital use. And so they cannot implement because they have to cover 100% of the capital under the regulation in Europe, etc. So just to explain, I come back to the regulatory part again. I'm sorry to say. So we have ideas like that, and it works, and the people wants to do it. Unfortunately, you have to unlock so many different small things to make it happen. Okay? So just to answer your question on that, and if you want, I have many other ideas.
You can talk to him in the coffee break, is what he's saying. Yeah, but we're moving on now to James, as you wanted to respond.
Yeah, again, it's on the same question. I mean, I think that we are starting to see some development of new financial mechanisms, or at least to start to value those cost savings. So I know that there was a coral reef resilience bond that was launched a number of years ago, where effectively there was restoration of the coral reefs, mangroves, etc. That reduces damages from cyclones and tropical storms, etc. And those organizations and companies and etc. that were based in the coastal zone and that were investing in the coral reef restoration then got cost savings from the insurance firms on their premiums, etc. And I think that that's a really neat example of how you can use, we're maybe not completely revolutionizing finance, but you can develop models which kind of value those cost savings. I think that that's a really critical point moving forward. I think, and going back to a conversation yesterday about, what's the value of the carbon markets, and are we going to start valuing more ecosystem services, etc. We will. The carbon market is the first step in doing that. We found one ecosystem service, which we globally now has a value. The onus is upon us to then start integrating those other externalities to business and the other ecosystem services and putting a value on them. And I think that when we talk about the climate mitigation adaptation discussion, I see it's going to, if we move towards the adaptation side, which we actually need to start investing in now, that is where the cost savings come from, and that is where we start to value these, the implementation of social innovation, nature-based solutions, all these types of efficiencies, because those types of values can then be picked up by the insurance and the reinsurance firms, which have that long-term view, as Pierre's already highlighted. So I see things developing much more towards the adaptation space, and that is where I see the some of the solutions to the question that you've posed as coming from.
Thanks, Leah.
Yeah, so it's a really great question. And I think we look at financial models in two different perspectives as well. One being an insurer, i.e. underwriting model, and the other being an investor financing model, both of which have different algorithms, of course, and approaches, and different longer-term, shorter-term perspective. So with respect to investor financial models, one of my favorite quotes that I heard recently that an institutional investor said to me was, I need this first loss to make my Monte Carlo model work so I can take this deal to my investment committee. So I really appreciated that, actually, the level of transparency, because he was using first loss from the perspective of blending, such that the Monte Carlo model needed to hash out some level of perspective that was achievable, supposedly, and that the IC would eventually approve. So that's one perspective, and it's not a wrong perspective. I think with insurers, that's a tremendous opportunity that can't go underserved. And I think James articulated well, and Pierre's, and I don't have a lot to add to that except for getting the attention of the insurers. I remember years ago, long before blended finance was blended finance, I was working structured finance on Wall Street, went to my actuary, Charlie, I remember his first name, and said, Charlie, can I develop a new insurance product that would speed delivery of bed nets to Africa? And he looked at me and said, I don't think we have enough data to do that. Now, fast forward, we were able to eventually create the product, but the question mark in my mind is how many Charlies are out there, and subsequently, how many underwriting models haven't been updated. And I'll just end by saying very quickly, too, that the overall archetype of blended finance is worth updating, too. It was launched in 2017 at the Addis Ababa Innovation Finance Summit with the goal of recognizing there are about 5 different archetypes associated with blended finance that could be used to scale up private capital for SDGs. I say that because we're pretty close to 2030, so it's worth relooking at those archetypes, and that might be something Convergence needs to do as a takeaway.
Interesting, and I really like this forward-looking question. Blended finance is this catalytic thing that's supposed to help catalyze something, so it can't be permanent if we really are going to drive proper financial tools, new approaches, new ways of financing that will value impact. So what does the future look like without blended finance when we've got it all right? Like what's the goal that we're working towards? What's your goal? So I'm going to ask each of you to take a couple of minutes and think about what's the end goal like? What does finance look like when we get it right? Like what should we be working to? Because keeping that in mind allows us to the comment made yesterday, when you've got to scale things up, but at some point you've got to scale things back, right? So it's good to keep it in view. So who would like to start in response to that question? Oh, Leah, brave. Good, go.
Okay, I'll make it brief since I just took up a bit of time. I mean, from my perspective, and perhaps this is a broader perspective, is new product development. And that requires experimentation, innovation, and then landing on products that work, that are scalable and replicable for the financial markets to lean on and mainstream.
Maybe I'll go quickly next. The reason I think that we have blended finance models is because we fundamentally don't yet value externalities, particularly coming from a green finance and advisory organization. What I see with the developments of the TNFD, the Task Force for Nature-Related Financial Disclosures, the TCFD, the Task Force on Climate-Related Financial Disclosures, SBTI, SBTN, that's starting to get companies and also investors and financial institutions to understand their impacts and dependencies on nature. And as they understand their impacts and dependencies on nature, they can start to understand the value that has and the financial impact that has on their business and their business model. And as that develops, blended finance will in some point fall away, at least in relation to nature impacts and nature investment, given that we would understand just how important and valuable those ecosystem services are. But this is a comment broadly about the financial model that we've lived with for however many centuries.
Yeah, I think I will say it maybe on a different way. Impact will be part of any future financial decision. So this is a toolbox. We told you this is one of the toolbox to start to think on this way. Finance has been built so far on a linear growing economy. The linear growing economy is not the model in the future. We are either disrupted or circular. So we need to readapt finance to that model. And this is one of the toolbox, as we say. And I think we do not consider this enough as a toolbox. I just want to say, one of the best transactions I've done in blended finance are with securitization. But securitization is what created the crisis of 2008. So the 2008 was not securitization which was wrong. It's because it was done for speculation. And speculation is the big enemy we have, by the way. This is also what we may have in the carbon credit market. Today is led by speculation, and it's not led by the fact that we want to make impact. So if we need to think that impact will be part of every single, so we need to have tools to do the transition in finance who will bring us that one day when we will make a decision to finance or to invest, we will say, is it a climate, is it biodiversity, or is it societal integrated? And that means what? That means you have a business which normally offset carbon or even sequestered carbon. We have a business which is regenerating biodiversity, and this will have a value. And this is where we are going to. That's the final goal.
Jiao?
Yeah, I fully agree with what has been already said, and I'm just going to give one example of why catalytic finance is needed, maybe just to bring things to a very simple terms. There are projects out there which brings great impacts, and I'm from the waste management kind of sector previously in waste management infrastructure, and we see, in lower income countries, wastes are dumped on the streets and on dump sites. There's tremendous pollution to the water and air and open burning, all sorts of environmental hazards. And yet, it's really hard to finance those transactions or projects, let's say, because there's so many risks that it's real risks, but also perceived risks from the private sector, and the public sector doesn't have enough to develop those projects. So we see this is an example where we use catalytic or blended finance tools simply to go into uncharted sectors, uncharted projects that are not being invested or just lacking finance. So I think that's the purpose of blended finance, to put it in a very simple term. And there's one, I will be very quick here, one point that Pierre said about responsibilities of partners. We need to work in partnership with common vision, to sit on the same table, to create solutions, innovations. But also, I think, in my view, different partners have different expertise. GCF, I think it's done great in providing the initial financing. I don't think, in my opinion, it's realistic for them to expect them to be responsible for everything. In my opinion, I think it's more efficient and effective to construct a governance where everybody is responsible for what they're good at, and to make this whole ship work.
Thank you very much. Well, I hope you'll agree with me that our panel was very good at their conversation. So thank you very much. The coffee is outside.